already started. Let's look at problem 18 in chapter 6. That's on page 296. Everybody have it? So this one is asking us to calculate the break-even point for a multi-product company. So in some cases, the company might only make one product. In other cases, they might make 2 products, 3 products. Sometimes they make thousands of different products. But in this example, this sports corporation is a distributor in the Philippines of golf balls. And they have 2 types of golf balls. One they have branded, their master brand is Flight Dynamic, and the other one is Sure Shot. And what they tell us here is the monthly sales, and in this case, it's in pesos, but that's not going to affect our calculation for this analysis. And it tells us the contribution margin ratio. So it tells us the sales for each, the contribution margin ratio, and it tells us that fixed expenses are $183,750 per month. All right, so the first thing I want to, just as by way of review, that I want to ask you is, how do we calculate the contribution margin? Because that's important. So who could tell us? Somebody?
Sales minus variety.
Tatiana? Irina? Okay. I'm just testing to see. I want to make sure. That you know. Okay, so tell us, Irina. Correct. So from sales, we subtract the variable expenses, and that gives us the contribution margin. So let's look at this example. Now, the first thing they want us to do is to create a contribution format income statement for the entire company. So what that means is that we have to combine the sales and the variable expenses for these 2 product lines, Flight Dynamic and Sure Shot. All right, so this is how we're going to set it up. This is our contribution margin format income statement. So just like on any income statement, we're going to have sales. But here we don't make the distinction, right, for this format, for this type of analysis. We don't make the distinction between, as we did in earlier this semester, between, for example, the selling, general, and administrative expenses, the total manufacturing cost, the cost of goods sold, right? So we know that an income statement can be very detailed and have many lines. And earlier we made an important distinction that we said that there's SG&A and there's cost of goods sold, right? We have product costs. Our product costs are what? What do we say our product costs are? Who remembers? You got a minute? Right. It's like our fixed costs, our costs that are fixed. But what are our product costs? So manufacturing overhead is one of our product costs, and what else?
Materials, direct labor.
Go ahead, Damon.
Raw materials, direct labor.
Right, the raw materials, direct labor, we said those 3 combined are the product costs. And we said that's different from selling general and administrative. So the raw materials, that plastic that we're buying from Turkey, that's part of the raw materials, which we said is an asset, which is an inventoriable cost. But right now, what we're going to do is we're going to keep it very simple. And we're just going to focus on sales, variable expenses, and fixed expenses. So we have our variable expenses. And we subtract that from sales. And that gives us our contribution margin. Then we subtract our fixed expenses. And that gives us our net operating income. Why, for the purpose of this income statement format, are we able to do this? What is it that we said early in the semester about product cost and selling general administrative that makes this reasonable, that this makes sense? What did we say about product cost, for example? Remember we said that product cost could be both variable and fixed. And selling general and administrative can be both variable and fixed. So when we talk about variable expenses here, we're already including the selling general and administrative and the product cost, the manufacturing cost and the non-manufacturing costs. Everybody follow? So that's why this is, we're not like leaving anything out here. It's the variable expenses, all variable expenses, whether they're manufacturing or non-manufacturing. So what do they tell us for, now we have two product lines. We have flight and sure shot. And then we have the total for the company. So what do they tell us the sales are for flight? 150,000. Oh, that's right. You're right. let's say 150,000. And when we're looking at variable expenses, we want to know as a percentage of sales. So sales is 100%. And then what about for sure shot? What are the sales? 250. And then they tell us for the total company? Or what about the variable expenses? Now, this is where there's a little bit of critical thinking here. Right? This is where you have to think this through. So let's work with what we know, because they don't tell us what the variable expenses are, but they do tell us what the contribution margin ratio is. So they tell us right? This is why you want to go over this, right? You got to think about this. They don't tell us the variable expenses, but they tell us that the contribution margin is 80%. Did I get that right? For flight, they tell us that the contribution margin is 80%. For sure shot, it's 36%. And this we have to calculate this. This we don't know. So if the contribution margin is 80%, then variable expenses must be what percent of sales?
20.
So that's 20%. So if that's 20%, then how much is that?
20,000.
Okay, whoa, wait a minute. I heard some people say 20,000?
30,000.
30,000. 20% of 150,000. So that's 30,000. And then we subtract the 30,000 from the 150 and we get 120,000. So 80% of 150,000 is 120,000. All right, so what about for the sure shot product line?
64%.
What is it?
64%?
64% of sales is variable expenses, which is how much? 160,000. And then that gives us contribution margin, a total contribution margin of? All right, now we could look at the fixed expenses. So do we know what the fixed expenses are?
Yeah.
What are they? 183 for the entire company, right? What do we know about net operating income? No, we don't know. Okay, so we need to calculate that. All right, so what is the variable expenses for the total company here? 190,000. Which gives us a contribution margin of 210, right? So from the contribution margin of $210,000, we subtract the fixed expenses of $183,750. That's the fixed expense for the entire company, which in this case is the combination of these two product lines. And that gives us a net operating income of $26,250. So what is the contribution margin ratio? 52.5 for the entire company, and which is variable expense. So what do you find interesting so far about these two product lines and the overall profitability of the company? So the company is profitable, but the profitability of the product lines is not equal. So which product line is more profitable?
Less. Because less expenses.
What do you think? You want to vote? How many think flight is more profitable? And how many think sure shot is more profitable? All right, so tell us why you think flight is more profitable. Based on what? So the contribution margin is 80%. And here the contribution margin is 36%. So regardless of the total dollars, it just so happens that in this case, the total dollars in contribution margin is greater. That doesn't need to be the case. The reason why the contribution margin here is so high actually is because the sales for sure shot are $100,000 more than for flight. So on a percentage basis, flight is more profitable. And also, if you look at the dollar amount or the pesos, in terms of total pesos, the contribution margin is also more. So we need to look at both. We need to look at both the percentage and also the dollar amount or the total pesos. Because this number actually, this could have been just 20,000. Because suppose, well, let's say for example, if this number was 50,000 instead of 100,000. Then this would be only what, like 47,000? So it's not just the dollar amount that we need to consider. We need to consider the percentage. Because if it's very profitable, maybe we have a very small share of the market. But yet our percentage, right, our contribution margin percentage is very high, like in this case. Our percentage could be very high, but we might have a very small market share. So in that case, our decision as accountants, as managers, as executives is then, well, okay, how do we grow this business? Because it's very profitable, even though sales are very limited. And even though sales here are much more, it could be less profitable. And look, for example, here we see that the variable expenses are 64% of sales versus 20%. So at some point we're going to have to make a decision, and we're going to continue to evaluate the product lines and determine which product lines we're going to keep, which product lines we're going to discontinue. So we're going to certainly be looking at the level of sales and the level of profitability for each product line, not just for the company as a whole. Questions? All right, let's look at the next part of the question, which says, compute the break-even point for the company based on the current sales mix. All right, so what we're going to calculate now is the dollar sales to break even. And the way that we calculate that is the fixed expenses divided by the overall contribution margin. Right. Why do we need to calculate this? Why is that significant? Because break-even volume, that's, you need to realize that that's a very important concept in business. And you're going to be looking at that again and again and again. Why? Why do you think, David? Why is this so important to us as executives and managerial accountants? Why do we focus and spend a lot of time talking about break-even volume?
So that you know how much goods you have to produce, manufacture, and that you're not, your sales won't end up being below your total cost of goods sold. So you make sure you're coming out at least even by the end of the budgeting period.
So so we want to make sure that we need to know how many units we need to sell, or how much our sales need to be in order for us to break even. So we're not even talking about making profit yet, just the minimum. How many units do we need to sell to break even? And the reason that's so important is because we need to determine whether or not that number of units is realistic, whether or not that's attainable. So it's not just interesting, it's got to be actionable. So if we find out that the break-even volume is 10,000 units, then maybe we say, well, that's realistic for us to pursue that opportunity. Because the market might be not 10,000 units, it might be 10 million units. So in other words, that's the number of units of that particular product that's, let's say, sold in the United States. So if the number of units that are sold in the United States is 10 million, and our break-even volume is 10,000, then we say, well, that's not even 1% of the market. It seems reasonable that that's something that we could achieve. But maybe for us, based on our cost structure, the break-even volume, because we're paying too much for plastic, because Alex went on vacation, and now we're stuck with this price increase, and we can't be profitable at that level. So we need to know, information is power, but more importantly, information needs to be actionable, and it's really only powerful if it's put to use. So this is critical that we know this, know what the break-even volume is. So what is it in this case? How do we calculate it? What's the fixed expense here? So it's 183,750. And that tells us, right, in this case it's 350,000 pesos. So that's the level of sales. So this is the break-even level of sales. So at 350,000 pesos, if we achieve this level of sales, we're going to break even. So that means that we need to tell our sales team that we need to achieve a level of sales higher than that. So we might tell them that our target level of sales is 1 million. Because we know at 1 million, we know we could calculate how much our profit is going to be. We know that we'll be profitable. Because remember, this is only the amount of the level of sales at which we're going to break even. That we're covering our costs. And the next part of the question is what? It says, what if sales were to increase by 100,000 pesos a month? By how much would you expect net operating net income to increase? What do you think? Right, so what happens if our sales go to 500,000? How much is our net operating income going to increase?
I mean, it depends because they're not specifying whether it's that they're making more, more units, or is it that they just raise the price? So if it's just a raising the price and the variable price stays the same, then it's wholly going to increase by 100,000. As opposed to they making more units, then of course the variable expense will also increase.
Everybody catch what Melissa said?
Mm-hmm.
So Melissa's saying that if we're selling more units, then our variable expenses are going to go up because we're using more plastic. But we know something else though. We've already converted this into percentage. But what Melissa's saying is absolutely true. But what can we do with the information that we have with regard to the percentages? So what do we know? If these percentages stay the same, so if the variable expenses remain the same percentage of sales and the fixed expenses remain the same percentage of sales, then what's going to happen? What's going to happen to our net operating margin?
Divide 100,000 to that percentage and into the total.
And how much is that going to be? Not divide. It's going to be, the incremental sales is 100,000. And the contribution margin ratio is 52.5%. And then we need to footnote what Melissa said, right? So that's based on those assumptions that the variable costs are going to remain at the same ratio relative to sales. Questions? So we know that's what's one of the things that's helpful about looking at it in terms of ratios is that we could calculate and make some predictions. Because remember, again, we're looking at the future. We're trying to make some decisions about what's going to happen in the future. To be very different, right? We said that there's a difference between financial accounting and managerial accounting. Financial accounting, we already know. Right? Melissa already knows how much the variable expenses were. That's historical. We know what variable expenses were last year. We know what fixed expenses were last year. But we're trying to figure out, right? We're doing this what if. Remember I said we're going to keep looking at what if. What if sales increased $100,000? Because one of the things that we're going to need to decide is what if sales increased $100,000 because we spent $25,000 on advertising? So we need to decide, look, should we advertise? And then, of course, the question is, well, if you advertise, how much would sales increase? So you're going to make some assumptions. And in this case, let's say we assume that we're going to spend $25,000 on advertising, and judgment of the management team is that that would increase sales of the entire company by $100,000. So sophisticated managers know, well, wait a minute, sales are not everything. Okay, sales increase, but what's going to happen to our profits? So our sales are going to increase enough to offset the additional expense of advertising. And in this case, advertising would be what type of expense? Variable or fixed? It would be a fixed cost. Because it's not something that we could trace back to a particular product. In this case, we're advertising for the entire company, for this sports company, sportswear company. So that's why we need to go through this type of analysis. That's why we keep looking and saying, well, what if this? If it increased 200,000, what would happen? That's why we're trying to do these calculations. All right, so that's problem 618. Let's look at this problem. in this situation, where we have this company, all right, this is the company, and this is the unit sales, 120,000 units, no, 12,000 units, 12,000 units. The price per unit is $100. The variable cost of $50 per unit. And the fixed cost of $300,000. All right, so this is the question. If the contribution margin in dollars per unit, all right, so we don't, this is the information that we have. We still need to calculate the contribution margin. If the dollar contribution margin per unit is increased by 10%, total fixed cost is decreased by 20%, and all other factors remain the same, what will happen to net income? Right, so what we need to do is we need to calculate the contribution margin and the net income. So we're going to set up, just like we had before, the contribution format income statement. Right, but this is a different application of the same concept. Crystal.
Is that 150 or
50. 50, I mean, 50. All right, so remember we start with sales. We subtract the variable expenses. That gives us the contribution margin. And then we subtract the fixed. And that gives us net income. Do they tell us sales? How much are sales? 800,000, 900,000, 750,000? They don't tell us, so we need to calculate that. So how do we calculate sales? Right, what do we know that we could use to calculate the dollar amount of sales?
Number of units and price.
Okay, Lena, tell us.
That's number of units and price per unit.
Right, so they tell us the price per unit is $100, and we're going to sell 12,000 units. So in order to calculate sales, we multiply 12,000 units. We're going to sell 12,000 units, and we're going to sell them at $100. And that's going to give us how much? Now, what about our variable expenses?
Number of units multiplied by.
Go ahead, Lena, tell us.
Number of units multiplied by variable expense.
Right, so here this is the variable per unit, $50 per unit. So 12,000 units times $50 equals 600,000. Everybody follow so far? And that gives us a contribution margin of how much? And then they tell us that the fixed cost of 300,000. We subtract the fixed cost, and that gives us a net income of 300,000. But we're not done. That's the first step. But it says, what would happen if there was a 10% increase in the dollar contribution margin and a 20% increase in the fixed cost? What would happen to net income? So what does that mean? What would be, who can give us an example of and explain to us what's happening here? If we're saying that there's a 10% increase in the contribution margin, so that means that this is going to be, what? So this is the change. So this is plus 60,000. And then it says a 20% increase in fixed cost, right? So that's also another 60,000. So the change is 120,000. So the question is, what's going to happen to the net income? So this is now 660,000, and this is now 360,000. No, wait a minute. It says fixed cost, total fixed cost, it says decreased, I'm sorry. Right? Total fixed cost decreased by 60,000. It said a 20% decrease in fixed cost, a 10% increase in the contribution margin. $240,000, and then that means that fixed cost from the contribution margin is $420,000. So what's going to happen to net income? What happened to net income here?
It increased by 100.
This is your company. Tell us what happened.
It increased by 120,000.
Right, so net income, there was a 20% decrease in fixed cost and a 10% increase in the contribution margin. What could result in a 10% increase in the contribution margin? What does that mean? What could be happening in this company? What do you think?
Either they started charging more for their product, or they maybe changed suppliers, so now the variable cost is cheaper somehow.
Absolutely.
Fixed cost. Fixed cost change.
Well, this is the thing.
Are
We said
talking about
that.
contribution margin? You asked about contribution margin, right? Why did it
Right.
increase?
We said contribution margin is going to increase 10%. So the question is, what could have caused a 10% increase in the contribution margin? So what Vladimir was saying is that, well, if the contribution margin increased, that means that either the variable expenses went down, right? Variable expenses went down, or sales went up. So Vladimir was saying, well, maybe now we're charging, instead of $100 per unit, $125,000 per unit. $125 per unit, right? So we have to know what's influencing, what could possibly cause that change. Because sometimes when we're doing an analysis of a company's financials, we don't know. All we know is what the bottom line impact is. Then we need to figure out, well, what's causing that? And it could be that one company is very unprofitable, or the manufacturing facility burned down. There could be a lot of different reasons. We need to understand what the drivers are. What's going to cause that? So that could increase the contribution margin by 10%. Now, if we sold more units, in theory, that could increase the contribution margin. That means we would be more profitable, but as Melissa was suggesting before, well, if we sell more units, then our variable expenses are also going to go up. Unless they say, you know, the first 12,000 units of plastic you have to pay for, and everything after that is free or something. I don't know, depending on what kind of deal you have. Maybe it's $50 per unit for the first 12,000 units, and then after that, maybe it's just $1 per unit. So it depends what type of deal that you negotiate. And that's really not so crazy. A lot of companies require a minimum amount of sales, like suppliers. They have what's called like a guaranteed sale. And then after that, it would be, instead of a flat rate, like instead of $1 million worth of plastic, they say at minimum you have to buy $1 million worth of plastic. And this is how many ounces you would get. But after that, then it's could be per ounce, and it's going to be maybe at a significantly lower rate, because they're going to achieve some economies of scale once you achieve that very high volume. So if their costs go down, then it's up to them whether or not they want to share that savings with their customer. So in this case, the net income is going to increase by $120,000. What could cause a 20% decrease in the fixed cost at Laleta's company? Why would fixed costs go down 20%? What could be some of the reasons for that? What do you think? Layoffs, but we got to be more specific. Layoffs of who? Right, if the CFO got laid off, that would be a fixed cost, because that's not, the CFO's salary is not dependent on the number of units that's produced. It's not dependent on the production volume. So that could have a very significant impact on the contribution margin of this company. Why? Because he didn't know how to do this analysis. They never showed him how to do break-even volume analysis. And that's why. So they fire him and hire Crystal. What do you think? You want to hire Crystal? She could do it. She'd be a better CFO. Look how much money we'd be saving. So fixed costs would go down. What else? What else would be an example of a possible decrease in fixed costs? So we said fixed costs went down 20%, which in this case would be $60,000.
Rent, no.
Rent? Yeah, the rent may have gone down. Because you might have renegotiated with your landlord and got a better deal on the rent. Or there was a rate decrease on your insurance. Or maybe property tax went down. So maybe the municipality where Laleta operates her facility is concerned that she might move her operations to another state, or maybe even to another country, and they say, we're going to reduce your property taxes $60,000. And that's not uncommon. In fact, local governments understand that they need to protect jobs in their community, and so either they're going to lay people off, or the government, the local government, is going to help subsidize the company. So very often there's tax abatements that help the company be more profitable. So say, you know what, if you build your manufacturing facility here, you don't have to pay any property tax. Now, most manufacturing facilities are actually quite large. Usually an average manufacturing facility, a distribution center, might be 1 million square feet. So to not have to pay tax is a very significant incentive for the company to stay there. So they're definitely thinking, oh, gee, what if? They say, what if the mayor or the governor agrees to waive our property tax? How is that going to impact the profitability? Then they could decide how many workers they're going to lay off, whether or not people are going to get bonuses, whether or not people are going to get raises. Questions? All right, let's look at this example. All right, let's see. It says Damon's company produces headphones that it sells for $60. All right, you got this? Damon's company produces headphones that it sells for $60. Variable manufacturing costs are $30 per unit. So they didn't tell us yet how much the non-manufacturing costs are. Remember we said there's manufacturing costs and non-manufacturing costs. They said variable manufacturing costs are $30 per unit. Fixed manufacturing costs are $10 per unit based on the current level of activity. And the fixed selling and administrative costs are $8 per unit. So the SG&A, which is the non-manufacturing cost, is $8 per unit. So we have our variable manufacturing cost is how much?
$30.
$30 per unit. And the fixed manufacturing cost, $10 per unit. And then it tells us the fixed non-manufacturing cost, which we said also we frequently refer to as SG&A, which is how much? Is it $8 per unit?
Mm-hmm.
$8 per unit. Then it tells us that we have a sales team that gets a 10% commission. So we're going to give Abigail, you okay with this, Abigail, right?
Yeah.
10% is all right? So 10%, we're going to give Abigail 10% commission, and it's 10%, the commission is 10% of the sales price. So we said the sales price is $60 for those headphones. What do you think? Is that reasonable? $60 for headphones? Okay, $60. And the variable manufacturing cost per unit, right? This is per unit. Per unit. Let me say $30. Variable manufacturing cost is $30 per unit. And that gives us a contribution margin of $30. Well, first, actually, well, let's take the, this one we got to add in the commission. Minus the commission, which we said is 10%, $6, right? $6 per unit. Which gives us a contribution margin of $24. So that's the contribution margin. Why is this variable? This is actually, we could actually put this as variable SG&A. So this is the manufacturing cost, and this is non-manufacturing cost. But they're both variable. Why? Why is this? We said this is commission.
Commission is very,
Well, why?
because we don't know exactly how many, how many units she's going to sell. Because we can't make fixed cost of commission. And predict.
Well, it could be a fixed. Well, her compensation could be fixed, right? We could.
10%.
No. I mean, it could be fixed, but in this case, we're saying that it's variable. But we could agree on a fixed salary for Abigail as our sales manager, and just tell her we're going to pay you
Yeah, but
$75,000 a year.
But that doesn't call commission. That calls-
Right. So, but I'm saying in this case, where she's going to get paid a commission, so why is that variable? Why do we consider that to be a variable expense? Yeah, Damon?
Wouldn't the total be variable, not the fixed cost per unit?
Wouldn't the total will be variable? Which total?
Per unit. On the $6, wouldn't that be fixed?
The $6 is a percentage of sales.
So total sales or sales per unit?
Ah, that's a good point, Damon. Everybody see what Damon is saying? Do you ever watch Vampire Diaries? Don't worry. Lena doesn't either. But
Variable cost per unit.
there's a character in there whose name is Damon. Actually, he's one of the main characters. He's very interesting. He always makes frowns his face and makes all kinds of facial expressions, like things like that. But he's a vampire. He's a vampire. Crystal knows what I'm talking about. Oh, David raised a really good point. What about True Blood? You watch True Blood?
Oh, yeah.
First sales.
Yeah, that's an interesting show. Come on, Crystal. Stop trying to play it off. Yeah, whatever. I know you watch it. Yeah, David raised a good point. He's saying that if this is 10%, if we're looking at the unit level, this is always going to be 10%. So if this is always $6, right? Because this is $60 at the unit level. What we're saying is that if we sell 1,000, if Abigail sells 1,000 units, then she's going to get $6,000 commission. If she sells 3,000 units, she's going to get $18,000 commission. It's sounding better all the time, right, Abigail? Now, your name is not Irina by any chance, is it? No? Okay, good. So, $6,000, we could see here why this is variable, because a variable cost is one that varies with the level of activity. So in this case, the more units that you sell, the more dollars you're going to take home, the greater your level of commission.
How come the fixed manufacturing is $10 per unit? What you say?
Right. So if we go to, we could continue our income statement and look at the fixed manufacturing cost, which is.
But that's per unit. What you say?
What's that?
The $10 per unit.
Yeah.
Right? The fixed cost should be the total amount.
Well, we could look at it both ways. Right, so I mean, this is very helpful for us. Remember, we looked at another example. The reason why we want to look at per unit, why we want to try and understand that, is because the next thing we're going to do is we're going to say, well, if it's $10 per unit, then what if it was 1,000 units? What if it was 3,000 units? What if Abigail brought home 10,000 units for us? Then we still need to be able to go through this analysis to figure out how is that going to impact the profitability of the company. Because I know Abigail is doing that analysis, and she's going to come to us and she's going to tell Mary $6 a unit is not enough. You said 10%. But she says, no, I took this managerial accounting course with Professor Bassell, and I understand how to do this. Look, if I'm bringing you guys 10,000 units, then this is how much profit I'm generating for the company. So 10% is really not enough. Comments? What do you think? Right, we need to look at it at the unit level. But you're right, that's going to, depending on the level of activity in this case, right, we're going to have to multiply that by the number of units. Right, but I know what you're saying, it's fixed. But what we know from a previous analysis is that, and this is something that we assumed here, is that in the relevant range, right, within the relevant range, the fixed manufacturing cost is $10 per unit. And then what we want to understand is how that might change if we increase the level of production. But I agree, when we look at it at the unit level, it seems a little counterintuitive. And you're saying that it's fixed at $10 per unit, but that's because we're looking at it at the unit level. Right? That's what Damon was also suggesting, is that if we're looking at it at the unit level, but that's all we have is we know this is the price, these are our variable costs, and these are our fixed costs, and that's our contribution margin per unit. But we haven't said how many units that we sold. So once we take that into account, then we're going to say that approximately per unit within the relevant range is $10 per unit. And then once we go above that, our fixed costs might increase because we might have to pay more property tax, we might have to pay more insurance. But we have to make some assumptions. So here the contribution margin is $24. So Abigail, you want to renegotiate? No, you happy? Okay, good, good. We'll see. Maybe we'll give you a bonus. Okay, let's look at Olga's company. You didn't know you had a company? company, right, Olga? Like you do. Olga has this company. Everything we're talking about now in chapter 6 has to do with costs and how costs relate to volume and how that volume and costs relate to profit. That's what we're trying to understand is that relationship. So let's see what happens at Olga's company here. All right. $2,400,000 in sales. Not too bad. Not too bad. Variable expenses. Variable expenses are, actually this is, let's see, 2 million. 2 million in sales. 1,400,000 in variable expenses. And that gives us a contribution margin of 600,000. Minus the fixed expenses, which in this case is 360,000. Gives us net income of 240,000. All right, so we're going to look at a number of different calculations here. So the first question is for Olga's company is, we know that 40,000 units were produced and sold last month. That simplifies things a little bit, right? Because remember we did a schedule of cost of goods manufactured and we calculated the cost of goods sold. Here we're saying we produced 40,000 units and we sold 40,000 units. So that means we have no, in this case, we're going to assume we have no beginning and no ending inventory. So we have 40,000 units produced and sold. And the question is, what is the company's contribution margin ratio? So how do we calculate that? What is Olga's company contribution margin ratio?
Divide 2 million by 600,000, or 600,000 by 2 million.
Right, it's the other way around. So 600,000
30%.
divided by 2 million. Equals what? 33%?
30%.
30%. So 30% of $2 million is a contribution margin of 600,000. So this is 30%, this is 100%, and the variable costs are 70%. You were still making money. All right, now the next question is, think back to last class. It says, what if, I told you what if, right? I told you, you guys didn't believe me. I told you we were going to talk a lot about what if. What if the net income, if our goal was, having done this analysis, we say, you know, 240,000 is not enough. We do have our sales team. We're going to have a net income that's more than 240,000. So let's say we want our net income to be 300,000. So if our net income is 300,000, how many units would the company have to sell? So remember, this is at 40,000 units. So we're selling 40,000 units. And if we're selling 40,000 units and our sales are $2 million, what does that tell us? What do we know? If we sell 40,000 units and we generate $2 million in sales, what is the price per unit?
$50.
$50, right? Who is it? Nice, nice. So the question is, what if we want to achieve $300,000 in net income? How many units are we going to have to sell? So the first thing we have to do is calculate the contribution margin per unit. Right, the ratio is going to stay the same. What we're going to figure out is per unit. So what is the contribution margin per unit?
15.
Yeah, Damon, you said 15? All right, so tell us how you got that.
By 600,000 by 40,000.
Right, so 600,000 is the contribution margin, and divide that by 40,000 units. Gives us $15 per unit. Because remember now, what we're trying to determine is what if net income was not $240,000 but $300,000. So then what? Then what do we do? Okay, good. Wait, tell us where you got the 660. Good, good, good. So tell us what you did there. Net income. Go ahead.
300,000 plus the 360. Right there. And you get the contribution margin.
Which is
660,000.
yeah, you're right. You're right. You see, this is what you need to do. You need to be able to think critically. Right? You see how Crystal, not to be confused with Krista, Crystal, you see how she backed into this. Work with the information that we know. We know that our target is 300,000, and Crystal said fixed costs are costs that are fixed, right? So that's 360,000, and if that's 360,000, and we subtract 360,000 from the contribution margin and get 300,000, that means that the contribution margin must be 660,000. Everybody follow? So this we're told. We're told that the target net income is 300,000. This stays the same. Fixed costs are costs that are fixed. But what we don't know is what the contribution margin is. So algebraically, we just solve if our contribution margin minus the fixed cost is net income. This is what we know. Contribution margin we have to calculate. Fixed cost, Crystal is saying, is 360,000, and we're saying our goal is to achieve a net income of 300,000. So what Crystal did, I think, somewhat intuitively, is she said, well, right, is, and we're going to do that algebraically, is just solve this algebraic equation, and it gives us a contribution margin of 660,000. So that's what we just solved for. So now that we know that the contribution margin is 660,000, we need to find out how many units we need to sell to achieve that contribution margin. So what do we do?
Divide 660.
So divide the 660,000 by the $15, which is the contribution margin per unit. So we were 600,000. Now it's going to be 660,000 because why? We're selling more, so that means our variable expenses are going to go up. If our variable expenses go up, that means our contribution margin is, what's going to happen in the contribution margin? All right, so tell us, Elena. 660,000 divided by
$15, which gives us 44,000 units.
444,000 units. So we have to.
Now if we want to find a variable expense, we can divide 1,400,000 by 40,000, and then we'll get a price per 1 unit.
All right, so tell us. So the sales would be what? How do we calculate the sales?
Well, the sales, we divide 2 million by 40,000 units, which,
Right, which is $50.
yeah, and then multiply it by 44,000 units, and it gives us 2,200,000.
2,400,000.
200.
2,200,000. Let's see, how many units? 44,000. And it's gives us 2,200,000. And our variable expenses are
1,540,000.
1,540,000. Does everybody see how we got to 44,000 units? First, we calculated the contribution margin per unit. That means how much, if we subtract the variable expenses from the sales price, how much margin is left? So the contribution margin doesn't reflect the fixed cost. We just want to know how much is left after we cover our variable expenses. So we could calculate that, and at this level of sales, 40,000 units, the contribution margin is $15 per unit. So if it's $15 per unit, that means for each unit that we sell, we're adding $15 towards the contribution margin. Then how many units are we going to need to sell to achieve a contribution margin of 660,000? So how did we get into this situation? Olga said, what if, she said, what if our net income was not 240,000, but it was 300,000? And then we have to ask ourselves, well, how many units would we need to sell to generate that level of net income? And that's what we calculated. First, what we did was we calculated the contribution margin per unit, and then calculated the new contribution margin, which is 10% higher. So that the contribution margin is going to go up by 10%. And that means we need to sell 444,000 units if we want to have a target net income of $300,000. So do you see why we would want to do that? I mean, you think that's reasonable as a managerial accountant or as an executive? Why do you want to go through this analysis and say, well, what if it was 300,000? Or what if it was 400,000? Because then the next question is, if it's 44,000 units that we need to sell at $50, how are we going to achieve that? Because what we're saying is that we're going to have to sell 10% more units. When you go to Abigail and her team with that, you say, now this year you're going to sell 10% more units. She's going to think we're crazy. What do you mean? We're already selling 40,000 units. Now you want us to sell 10% more? How are we supposed to do that? So then, how are we going to do that? Remember, in another class we said, well, Odalis had told us we could lower the price. We could lower the price. Maybe we lower the price to $40. But that's going to definitely have an impact on the contribution margin. But maybe we would sell more than 44,000 units. Maybe our total revenue would go up more than 10%. But you need to go through the analysis and see, what if we sold 44,000 units? What if we sold 50,000 units? What impact would that have on the profitability of the company? Because Abigail might say, I need to hire another salesperson. And they're going to get paid $50,000. But then how do you justify that? Well, Abigail says, well, this person is going to be able to sell 5,000 units per year. Well, then if they're going to be able to sell 5,000 more units, then we could go through this analysis and see, this cost-benefit analysis, and see, does it make sense to spend $50,000 to hire another salesperson if they're going to be able to sell 5,000 more units? Or like we said with the advertising, does it make sense to spend $25,000 on advertising if it'll help us achieve this target net income of $300,000? What do you think? Would we be better off? Should we spend the $25,000? Yes? What do you think? Yeah? Why not? What is it that you're drinking here?
It's water.
What is it? Wine?
Yeah, red wine, white something up.
Questions?
Because there are $60,000 between both, you know, and so even though we will spend $25,000 for advertising, so we still want $35,000, and so it's good.
So our net income is going to increase by $60,000, and that increase in net income, the bottom line, is more than what we're going to spend on advertising. So, you agree? You're going to spend money on advertising? Good. Good, good. All right, so the next thing we want to do is figure out the break-even volume. What is the, at 40,000 units, what is the break-even volume? Go ahead, Greg.
It's fixed expenses over the contribution margin per unit.
Right. So in this case, the break-even volume is is going to be the fixed cost divided by the contribution margin per unit. And how much is that, Greg? 360,000, right?
Yes.
Is the fixed cost divided by the contribution margin per unit,
Which is 15.
which we already calculated is $15 per unit, which gives us a break-even volume of how much?
24,000.
So who could tell us what that means in this situation at Olga's company? We're saying that the break-even volume is 24,000 units. Go ahead, tell us, Greg.
They have to sell 24,000 units in order to break even.
Right. So to cover their fixed cost and their variable cost, they need to sell 24,000 units. So then what is the margin of safety? Who remembers what margin of safety is?
20,000. It's the difference between the total units minus the, what we just said, minus the break-even amount of units. So 44,000 units minus 24,000 units will give you 20,000. 20,000 units is the margin of safety.
All right, well, let's say, we'll look at both. We'll look at the original number of units and then with the increase. So the margin of safety, everybody remember what the margin of safety is? The margin of safety is the difference, go ahead, Crystal.
Actual sales minus the PV.
Right, the break-even volume of level of sales.
Wait.
So that's how much could sales decrease before we hit the break-even volume. Everybody follow? So how much is this in terms of dollars? So the break-even volume is 24,000 units, and the break-even dollar amount is how much? 1,200,000? 200,000?
200,000,
1,200,000?
yeah.
All right, tell us how you got that.
Multiply the break-even points. No, sorry, this is wrong.
You multiply it by the 50 or no?
Well, what we need to do to get the break-even dollar amount is we multiply the 24,000 units times the price of $50.
Yeah.
This is
Yeah.
So the break-even dollar amount is $1,200,000, which in this case means we'd have to sell 24,000 units just to break even. So the margin of safety is the difference between the level of sales, which in this case is 2 million. That means that the margin of safety in terms of sales is $800,000. That means that sales could drop $800,000 before we hit break even. So that means sales could drop 100,000, we're still profitable. 200,000, we're still profitable. 300,000, 400,000. Sales could drop $800,000 before we hit break even. Because remember, we said we're interested in what's the best case sales volume, the most likely case, and the worst case scenario. So we need to do that type of sensitivity analysis. We can't just assume that it's going to be $2 million. That might be the most likely, but sales might actually be only 1,200,000, and that would be the, in this case, the break-even volume. The break-even volume in dollars. So Greg was saying that if we sell less than 40,000 units, we could still be profitable. But the difference between the 40,000 units and the 24,000 units 16,000 units is the margin of safety. That we could sell 16,000 less units next year and we would break even. Below that, what's happening below that? What happens if we sell, instead of 24,000 units, what happens if we sell 23,000 units? What does that mean? We're losing money. If we sell 23,999 units, we're losing money. So the break-even volume is just the point at which we're covering our expenses. So you see why that's so important. But we need to know what our target is. What is our goal? What is it that we're trying to achieve? And that's why break-even volume is so important. Because that's going to help us make decisions for the future. So it's going to help us decide if we should spend money on advertising, whether we should hire another salesperson, whether we should expand the manufacturing facility. It's going to help us make an endless number of decisions. All right, in an organization, we need to have a budget. So we're going to look at the level of, well, we're going to look at sales. Let's say we look at sales. We're going to look at actual, budgeted, and forecasted. What's the difference between the three? What's the first one? We're talking about sales here. So we said there's three different types of sales. There's actual, budgeted, and forecasted. So what's the first one? What is that?
You actually need that here.
Right, so that's a little bit of financial accounting. It's what sales actually turned out to be. What we were able to achieve. Now, depending on where we are in the year, we might only know Q1. Or Q2. What's budgeted then? She beat you to it. Just quick draw McGraw. Good. So Crystal says that that's our goal. So budgeted sales is our goal. So that's where we're going to capture that what if that we were talking about. So we have to determine, we have to set a goal. And we might say that our sales per month, let's say, is $10,000. Let's say this is per month. then what is forecasted?
What they expect.
Yes, what they expect, and where is that information coming from?
Previous sales, marketplace analysis.
Yes, from Abigail, right? So forecasted, this number is this won't change. That's what we say at the beginning of the year, usually 4 months before the end of the fiscal period, the budgeted monthly sales amount is determined. So we'll know that our goal, as Crystal indicated, is $10,000 per month. Is going to be, let's say in January, is going to be $10,000 per month. This number is going to change because, as Greg is suggesting, based on market information, as we get closer, right now, presumably, we had reason to believe that it was going to be 10,000 based on where we expect, right, Greg said, where we expect to get distribution of our product and the price that we're going to sell the product and how many units of the product that we're going to sell. But then as we get more information, as we get closer to this period, January, let's say, we're going to adjust this number. Now, it could go up or it could go down. It might be 8,000 or it could be 12,000. So it might actually, we may have originally forecasted 10,000. That's still our goal. That won't change. But based on what Greg is telling us, based on what we expect, based on our marketplace analysis, based on what Abigail is telling us, now we have to say, well, how likely is that? What is the probability that we're going to achieve the budget? So Abigail says, you know, we really thought that we were going to get distribution, we were going to be able to sell our product at Target. But they decided not to carry the product. So now we know, originally we thought that we were going to, now we know that we're not going to be selling at Target, so that our actual, our forecast is now only 8,000 instead of 10,000. And at some point, basically the forecast and the actual are going to be the same, or very close. Because as you get closer to the period, then you should have better and better information. Right? We're doing this forecast 6 months, 8 months, 9 months ahead of time. How do we know what the sales are going to be in January a year from now? At some point, we'll have actual. But until then, we have to make a forecast. We have an expectation. Or maybe we actually found out that although we didn't get distribution at Target, we're actually going to be able to sell the product at Walmart. And Walmart has more than 2,500 locations. And therefore, we're going to change our forecast to $12,000 per month. So now we have what we call a positive variance. So we're going to look at variances. And we're going to look at the variance, the difference between what was budgeted and actual. And we're also going to look at the difference between what was budgeted, and we could look at what's forecasted. Because we want to know where there's going to be a shortfall. Now remember I said information is power, but really it's only potential power. It's only power if put to use. So what that means is when we find out this information, it's not, oh, that's kind of interesting. Yeah, we did that in accounting too. No, now is the chance for us to take some type of corrective action. And say, well, why? Why is that? Do we have a shortage of inventory? Is that the reason why we're forecasting only 8,000 per month? Is it because we ran out of iPhones? Or is it we have enough iPhones, it's just that we're not going to be carrying it at Best Buy? We're not going to be selling it at Best Buy. So we need to ask ourselves, once we find out that there's this discrepancy, we have to find out what's causing that. Maybe it's because our competitors introduced a product, or our competitors reduced the price of their existing product. So we need to know what the corrective action is. That's why this is important to evaluate. Not because it's interesting. I mean, it could be interesting, right, for Olga's company to do this analysis, but the question is, once you find this out, what are you going to do with this information? We have to take action. We're just going to say, well, it's 8,000 now. Greg was right. Now we did our marketplace analysis, now it's 8,000. Well, maybe Olga says, wait, I'm not going to give up. I will not go quietly into the night. I will not vanish without a fight. Right, Olga? She's going to spend more money on advertising. Well, if Dallas was here, she'd probably say lower the price. Which, maybe that's the best thing to do. Because in a price-sensitive market, remember we looked at that scenario, ideally what would happen if we lowered the price 10%, total revenues might increase by 20% or 25%. So our contribution margin actually might be higher, because we're going to sell more units at a lower price. But if we sell a lot more units at a lower price, then our total revenue will be higher and will be more profitable. So sometimes it makes sense to lower the price. But the market has got to be price sensitive. Not all markets are price sensitive. All right, let's look at an example. What we want to do now is, let's do a cash budget. Let's look at the problem 7-8, which is on page 342. We're always very interested in knowing how much cash we have on hand. Because while we're sitting here talking about fixed cost and variable cost and contribution margin per unit, at the end of the day we have these expenses, whether they're manufacturing expenses or non-manufacturing expenses. But in order to cover those expenses, not only do we need to sell the break-even volume amount or the break-even quantity, we have to have cash. Do we agree? So, in other words, we might have accounts receivables. Remember? You guys remember what accounts receivables are? That means we sold them the product. We shipped it to Tatiana's store. Right? You're Tatiana, right? And you're Irina?
Irina.
And Tatiana says, thank you. Right? Spasibo. Right? Thank you. I'll pay you next month. That's an account receivable for us. So we had the sales. So that's going to show up on our income statement. We generated sales, but we didn't get paid. So that becomes an asset. The account receivable is an asset from Tatiana, also known as Irina. But what about cash? We need to know how much cash we have, because in order to pay Mary's salary, and in order to pay Abigail her commission, we need to have cash. Unless, Mary, are you going to accept an IOU? Mary says, I got bills to pay myself. Right? Mary's got that huge electric bill and other expenses. So we have to give Mary cash. Or cash equivalent, right? We could issue her a check. But the money has got to be in the account. So that's why a cash budget is so important. That's what we're going to look at now, is how to prepare a cash budget and the information that, that it tells us. Because it's okay to have accounts receivables, and maybe we'll sell them. Maybe we'll sell the accounts receivables to Melissa. We might have to do that to get enough cash to pay our bills. That's called factoring. Right? When you sell accounts receivables, that's known as factoring. And factoring is very common. Factoring happens all the time. Factoring happens every time that you use your Visa card. That was one of Damon's expressions. Let's see. I'll bring it to class. Let's see. Watch it. He's always making those faces. What am I talking about? Every time I use my Visa card, factoring, selling of accounts receivables. Well, yes. You go into Macy's and you decide that you're going to buy, what should we buy there? Jewelry. Shoes, of course. You don't have enough shoes, right? There's never enough shoes. You never have enough shoes, right? Okay, we're going to go there, we're going to buy shoes. So what do? We give them our Visa card. And what actually happens is Visa pays Macy's. Visa pays Macy's. Let's say the shoes that Melissa buys is $1,000. What? You think $100 is more realistic? Okay, $100. But let's say she buys 10 pairs of shoes, and it's $100 a pair. So there she goes. She's already got 812 shoes. She's going to buy 10 more at $100 each. So the bill is $1,000. What happens? Visa gives Macy's $970. What happens? That means that factoring occurred. Macy's sold their accounts receivable. Technically, Melissa owes Macy's $1,000. Visa says, we're going to pay. You don't worry about collecting from Melissa. We owe you the money now. Melissa doesn't owe you the money. Melissa owes us the money. So Melissa owes us $1,000. So we're going to buy your accounts receivable, but not dollar for dollar. They're going to buy it for 97 cents on the dollar. So every time that happens, that's factoring is occurring. Now sometimes you could have, like in the example with Tatiana's store, where you could have account receivable where you ship merchandise and you give them 210 net 30, which means you give them a 2% discount if they pay within 10 days, or the balance is due in 30 days. Now, Tatiana owes us the money. We might go to somebody and sell that account receivable. The money that Tatiana owes us is an account receivable. We might decide to sell that so that we could get cash. That's also factoring. But I want to share with you the credit card example, because that's every time all of us use our credit card, where actually the company is selling their account receivable to Visa or MasterCard or Discover Card, but we really don't think of it because it just happens instantaneously. But as a company, we might have $10 million in accounts receivable because Tatiana owes us money, Elena owes us money, Crystal owes us money, Mackenzie owes us money, Greg owes us money. So we have $10 million in accounts receivable, and that's an asset, but we don't have any cash. And Mary says, homie, don't play that. She says, show me the money. Mary said, I'm not taking any IOUs or anything like that, and the check better not bounce. So let's look at this example, 7-8. Garden Depot is a retailer that is preparing its budget for the upcoming fiscal year. Management has prepared the following summary of its budgeted cash flows. So what we need to do is prepare the company's cash budget. So it shows us the cash receipts for the first quarter is $180,000, but then it says that the cash disbursements are $260,000. That's a problem, right? It said we took in $180,000 in cash, so we had cash receipts. Now, presumably that we have some cash on hand, or we have accounts receivable, because total cash disbursements are more than our cash receipts. In the next period, second quarter, total cash receipts are $330,000. Cash disbursements are $230,000. Third quarter, cash receipts are $210,000. Cash disbursements are $220,000. And in the fourth quarter, total cash receipts are $230,000. It's how much cash we received. And total cash disbursements are $240,000. So when we talk about sales, sales can either be cash or credit. So we need to know what percentage of our sales are cash or credit. So the company, they say they have a beginning cash balance of $20,000. And they require a minimum cash balance of $10,000. And it says they could borrow any amount from a local bank at 3%, which means that they have a line of credit. So it's very common for companies to have to borrow to pay their expenses, especially for businesses that are very seasonal, like at Macy's, for example. At Macy's, their lights, remember we said their lights are on 24/7. They never shut off the lights, because even when they're closed to the public, there's people there that are cleaning, that are rearranging merchandise, that are doing what they call floor moves. floor moves, that means they're rearranging certain parts of the store or installing new merchandising units. So they never actually really close. They still have to pay the electric bill. They still have to pay security. They still have to pay the sales clerks. But their business is very seasonal. A significant percentage of their business is done during the fourth quarter. The company may borrow any amount at the beginning of any quarter and maybe pay its loans or any part of its loans at the end of any quarter. Interest payments are due on any principal amount at the time it's repaid. And we're assuming that the interest is simple interest. So it's not compounded daily, for example. It's simple interest. So it's just a percentage of the amount that's owed. All right, so what we need to do is prepare the company's cash budget. All right, so we start off with the cash balance at the beginning of the period. And we have 4 quarters. Q1, Q2, Q3, Q4. We have total cash receipts. We're going to add those together to get the total cash available. Now in this example we don't look at, next time we'll look at when we have sales that are on credit. Less cash disbursements. So what we're trying to find out is what is the ending cash balance? So we're going to subtract the cash disbursements, and then we're going to have either an excess or a deficiency. Then we need to take into account that we're borrowing money. And the interest. Going to give us, so we have the principal and the interest. That's going to tell us the total financed amount. And then we're going to have the cash balance at the end of the quarter. So they tell us the cash balance. Now remember, the ending cash balance is the same as the beginning cash balance of the next period. Everybody follow? So the ending cash balance is going to be the same as the beginning cash balance of the next quarter. But here they tell us that it's $20,000. So that they tell us. This we're going to have to calculate. This we're going to have to calculate, which is actually going to be the ending cash balance. So then how much cash did we receive? How much did we receive in quarter 1? 180,000. And what about in quarter 2? 330,000. And quarter 3? 210,000. And quarter 4? 270. 230,000. Now, in this example, we're assuming that it's a cash-only business. So, at the beginning of the period, we had $20,000. We then received $180,000 in cash. which means that our total cash available is how much now? How much?
200,000.
200,000. And then, what is our cash disbursements?
260,000.
260,000. So we have a shortfall. We have a deficiency, which in this case is
60,000.
60,000. How much are we going to borrow? 70. Why? Tell us why it's 70. Why not 60?
You have to have a minimum of 10, so 60 plus 10.
Right. Everybody follow what Greg is saying? He said that, yes, we're short 60,000, but in this situation it says that we need to have a minimum of $10,000 cash. So it's 60,000 plus the minimum, which in this case is 10,000. Could be 20,000, could be 100,000. In this case they said it's 10,000. And then what is the interest rate that we're paying?
3%.
All right, so we're going to pay that at the beginning of the period, though, right? So we're going to pay that in quarter 2. So our total financing here is 70,000. And that means that our ending cash balance is $10,000. That's our target, our minimum cash balance. It says is $10,000. All right. So now we need to know what is the cash balance at the beginning of quarter 2.
10,000.
10,000, right, Damon? Tell us why.
It's the same as the ending balance from quarter 1.
Right. So if at the end of quarter 1 we had $10,000 in our checking account, then at the beginning of quarter 2, the next day, literally, then our beginning cash balance is $10,000. And if that's the case, then how much cash do we have available? How much cash do we have available now?
340,000.
Right, 340,000. We started the quarter with $10,000 cash. We had cash receipts of 330,000. So now we have $340,000 in cash. And then, what about our disbursements? For this quarter, it's 230,000. And so do we have an excess or a deficiency?
Excess.
Right, so how much is the excess?
110,000.
110,000. We need to borrow anything?
No.
No, we're good here. But now we have to pay the interest. So how much are we going to pay?
2,100.
How much?
2,100.
It's more than 2,100. Why? What does it tell us about when we borrow the money and when we pay the interest? So it says that we borrow the money at the beginning of the quarter or at the end of the quarter. Interest payments are due on the principal at the time it's repaid.
End of the quarter.
So 3% of 70,000, David said, is 2,100. Quarterly interest rate of 3%. But for 2 quarters. So this is 4,200 now.
So you're not borrowing at the end of the quarter?
Well, based on what they're telling here, we would assume that in this scenario that they owe for 2 quarters for the interest.
The interest rate should be the annual interest rate, right?
The what?
The interest rate is annually. Do that?
Quarter. Only if it's
The
quarterly.
3%, that's the quarterly or
Right, so there's a quarterly interest rate of 3%.
quarterly.
Right. Yeah, so if we're saying it's simple interest, then we would assume 12% annual.
Well, basically because you couldn't foresee that you were going to have a deficiency in money, so you couldn't borrow the money before. So being that you borrowed the money, obviously after the quarter ended, then you have to pay back double the next quarter instead of, right? Because it's the first quarter. Yeah, then you should only pay back 1 year, not 2.
One period?
1 quarter.
Right, 1 quarter. Company may borrow any amount at the beginning of any quarter and may repay its loans.
But they borrowed at the end of this quarter.
Why do you think it's at the end of the quarter? You mean you think they borrowed at the end of quarter
Well,
one?
because
Well, how would they know if it was in
Exactly.
the beginning? How would
Sure,
they
no.
know if they need to borrow money if
Yeah.
it was in the beginning?
if you're a normal company, you're gonna say, all right, quarter one, I'm gonna borrow 70 grand because I think we're gonna lose, you know? So,
Right, no, but that's what we need to do. But that's what we need to do, is we need to anticipate how much how much the shortfall is going to be, because otherwise,
Oh, so this is anticipation? I thought we were going by, since we have total cash receipts from what we actually made and received, the actual physical cash.
no, this is what we anticipate the cash receipts are going to be.
Oh,
Right.
all right, so we did borrow in the beginning.
Because otherwise, we would just be doing a statement of cash flows, right? After everything it's all after the fact. But this is looking forward, what we're anticipating cash receipts are going to be, and our disbursements.
Well, shouldn't we pay out the money at the end of quarter one? It says pay back at the end of,
Oh, we haven't even gotten to paying them back yet. We just want to pay the interest.
at the end of.
So what we're talking about is, well, how many periods do we owe the money? So based on this, we're saying, which I think was what you were saying initially, Greg, is that after doing this analysis, we find out we're going to have a $70,000 shortfall, so then we borrow the $70,000. And we put that in the bank, and then we're going to cover these expenses and then still have $10,000 left. So that means for 2 quarters, it would be $4,200. And so we're not going to repay the principal at this point. We're just paying the interest. Oh, but they say we pay it at the end. Yeah, we have enough money to repay, right? Because we have now we have an excess of $110,000. So we'll pay back the $70,000 that we borrowed. Right, so it was the first quarter where we had a problem. Second quarter, our cash disbursements are less, our cash receipts are significantly more, so now we have the $70,000 to pay back, because at this point we have an excess of $110,000. All right, so if we do that, right, if we pay back the $70,000, then what are we going to have as an ending cash balance? Right, $35,800 is the ending cash balance for quarter 2, which is the $110,000 minus the $74,200. What did you bring us, Steve? Something good? Which means that we have an ending cash balance of $35,800 and a beginning cash balance of $35,800. So we paid off the loan. We borrowed the $70,000 for 2 quarters. We paid it off. And you see why we were able to do that, right? You see this. These are cash receipts, $150,000 more than it was in quarter 1. And so the cash available in quarter 3 is going to be how much? 245,800. And our cash disbursements, they tell us, are 220,000. And we have excess of 25,800. We're not going to borrow any money. We don't owe any money. We're not going to pay any interest. So our ending cash balance is 25,800. That means that our beginning cash balance is going to be 25,800. And so our total cash available, right, 255,800, less our cash disbursements, 240,000. So we have an excess of 15,800. Again, we didn't borrow this quarter. We didn't have to pay any interest. So our ending cash balance at the end of quarter 4 is $15,800. What about for the year? Let's quickly look at the year. So our cash balance, all right, for the year, at the beginning of the period, that's not going to change. That's still 20,000. Our total cash receipts are $950,000. Our total cash available is $970,000. Cash disbursements we anticipate as being $950,000. That means we have an excess of $20,000. We borrowed $70,000. We pay interest of $4,200. So our total financing needs are $74,200. Actually, the financing at the beginning was $70,000, and then we left out the repayments. We had a repayment of $70,000. And our cash ending balance is $15,800. The homework for chapter 6 this week and for chapter 7 has a template, an Excel template, which you just need to fill in the numbers. All right, and you could just upload that onto Blackboard. So what you have to do is you have to go into View, and then add new entry. And then when you click on add new entry, then you see it says bold, italic, what else? All sorts of stuff. Shift to the left, centered, and then there's something that looks like this. A green arrow. That's for you to attach the file. All right, that's how you upload the file. Now, unless you unlock the file, because it's a template, unless you unlock the file, you won't be able to copy and paste it or highlight it. Damon?
Where does the 7,000 come from? Sorry.
Which one? 70,000, sorry. 70,000 is the amount that we borrowed, and I squeeze in another line here is the 70,000 that we repaid.
And what's the homework?
The homework, it's on Blackboard. Anybody remember what problem it is? What the problems were?
It's fun.
So you need to be able to know how to use Excel. How many of you have experience using Excel already? Good, 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 good. Because I always hear from the Accounting 5 and Accounting 7 professors, they always say that the students don't know how to use Excel. So they say, well, you're teaching accounting too. Why don't you teach the kids to use Excel? All right, but you guys know how to use this. I'm going to tell them, all my peoples know how to use Excel. All right, but we'll talk about that more next time. All right, so have a good night. Do good things. I'll see you Friday at the party. Party and party and party.